Welcome to this explainer. Today, we're unpacking something pretty wild. It's a tiny piece of plastic that totally transformed the modern world, and honestly, kind of rewired our human psychology along the way. Just think about it for a second. You can travel literally halfway around the globe, hand a clerk a little rectangular card, and boom, within seconds, you're walking out with your stuff. That clerk doesn't know you, they don't know your family, and they definitely don't know if you pay your bills on time, and yet, instantly, the transaction is approved. Well, it definitely wasn't always this way. Today, we're going to trace the fascinating journey of credit. We'll go from highly localized 19th century trust, where you were judged on who your parents were, all the way to the super sophisticated global mechanics of the revolving credit card sitting right there in your wallet.
Okay, let's dive into our agenda really quick. 1, what exactly is a credit card? 2, life before the plastic. 3, the installment plan boom. 4, the Diners Club revolution. And 5, the mechanics of revolving credit.
All right, Section 1. What is a credit card?
So, at its very core, a credit card is an instrument of something called revolving credit. Let's break this down, kind of explain it like you're 5. Imagine an issuer, like a bank, looks at your income and your history, and they say, okay, we'll grant you a fixed line of credit. Let's say $5,000. You can borrow up to that limit, pay it back, and then guess what? You can borrow it again. It revolves. Because you're constantly making new purchases and paying off different amounts, your total balance and your required minimum monthly payment are going to fluctuate from month to month. It's basically this super flexible, continuous buy now, pay later system. Now, to really wrap our heads around this, we kind of need to compare it to the other major type of consumer borrowing out there, which is installment credit. Think about when you buy a car. You use installment credit for that. The loan is for a fixed amount, the interest is calculated right up front, and you just pay it off in equal, totally predictable monthly installments until the balance hits zero. But revolving credit, it is completely open-ended. You are the one controlling how much you borrow each month, which also means you control whether you incur finance charges based on how much of that balance you actually choose to roll over. Moving right along to Section 2, life before the plastic. Okay, so this really brilliantly illustrates the dramatic shift we've seen in the American standard of living. Just picture an 1810s chamber pot. Back then, life was really all about basic rural survival. There was practically zero disposable income. But then fast forward to the consumer boom of the 1960s, and suddenly you've got bicycles, golf clubs, televisions everywhere. This didn't just happen by magic. Easier access to credit over the decades is what actually allowed everyday consumers to start acquiring all these non-essential, fun leisure goods. But, getting from the chamber pot to the television wasn't just about inventing cool new products. It required a massive, fundamental shift in how a society actually viewed debt. For a big chunk of the 19th century, borrowing money to buy a luxury item, like fancy clothes or a parlor organ, was considered totally imprudent. In some circles, it was seen as straight-up immoral. If you did borrow, you were probably using early localized merchant tokens or relying on a local shopkeeper who literally knew your family personally. And you only did it for absolute productive essentials, like buying seed for the spring planting against what you projected to harvest in the fall. You definitely didn't borrow just for fun. But then, as the Industrial Revolution really roared to life, a huge problem popped up. Factories were mass-producing these incredible new conveniences, like kitchen stoves and bicycles. But get this, the average American worker in 1890 earned just $475 a year. And that was for working like 60 hours a week. So it was just mathematically impossible for an average citizen to pay cash up front for these expensive manufactured goods. The products were there, but the purchasing power, not so much. That brings us to Section 3, the installment plan boom. Enter the Singer sewing machine. By the 1850s, factories could mass produce these absolute wonders, but they cost around $100. Remember that $475 annual salary we just talked about? Yeah, a $100 sewing machine was a massive, massive investment. So to actually broaden their customer base beyond just the super wealthy elite, the Singer Sewing Machine Company pioneered the installment plan. You'd put down a small down payment and then make fixed monthly payments. And just like that, suddenly the working class could afford technology that was totally out of reach before. Let's trace how this concept built up across the century. The installment plan was a huge hit. By 1919, General Motors Acceptance Corporation, or GMAC, took this exact same idea and applied it to cars, famously putting the American middle class on wheels. But notice something here. Singer and GMAC were still single-party lenders. The people extending the credit were the exact same people manufacturing the product. We wouldn't actually see the birth of the generalized multi-use credit card we recognize today until 1950 with the Diners Club and then 1958 with Bank AmeriCard, which, by the way, eventually became Visa. Honestly, the impact of this shift just cannot be overstated. As the historian Daniel Boorstin noted, it was hardly an exaggeration to say that the American standard of living was bought on the installment plan. Things like mass production, electrification, and mass communication in the 1920s only really worked because installment credit allowed average folks to actually go out and buy the ovens, radios, and washing machines that were pouring out of these factories.
Section 4. The Diners Club Revolution.
So the timing here was absolutely perfect. During World War II and leading right into the Korean War, really high taxes on corporate profits led companies to lavishly use these things called expense accounts to entertain their clients. It was basically a clever way to spend the money instead of just handing it all over to the IRS. And on February 8, 1950, a guy named Frank McNamara completely capitalized on this boom. He paid for his lunch at a New York steakhouse called Major's Cabin Grill using a little paper card numbered 1000. This was literally the very first charge on a nationwide travel and entertainment credit card. The Diners Club was officially born.
Now, we have to talk about the incredible friction this new system caused at first. Diners Club charged a hefty 7% transaction fee, and a lot of restaurant owners absolutely hated it. They felt like they had to raise their prices just to cover the fees, which ended up punishing their cash-paying customers. Plus, they actually had to wait for their money to come in. Some restaurants even straight up refused the card or added weird surcharges. But eventually, the sheer volume of high-end businessmen who just wanted to dash off a quick signature for a meal instead of counting cash, well, it forced the whole industry to adapt.
So the really crucial point here is that Diners Club represented a major financial breakthrough, the dual party card. See, Diners Club wasn't a restaurant. They didn't sell food at all. They were a third-party middleman. They'd sign up merchants, issue cards to credit-worthy consumers for a little annual fee, pay the restaurant the bill minus their commission, and then collect the money from the cardholder at the end of the month. This successfully decoupled the lender from the merchant, and that is exactly what paved the way for the universal bank cards like Visa and MasterCard that popped up later in the decade.
And finally, Section 5. Mechanics of Revolving Credit.
Look, the benefits of modern revolving credit are just undeniable, and they have entirely reshaped global commerce. I mean, you have this incredible convenience, right? There's no need to fumble around with cash or write checks. It helps build a credit score, offers fraud protection, and it continues to fuel our rising standard of living by letting us buy stuff now and pay for it out of our future income. But perhaps the most miraculous part is how it replaced the need for slow, localized trust. Thanks to powerful telecommunications and centralized credit bureaus, a merchant in Tokyo can instantly trust a tourist visiting from Boston, literally just by pinging a computer network. It's wild.
But, and this is a big but, all that convenience comes with a powerful psychological trap. Behavioral economists actually call it the pain of paying. Here's how it works. When you hand over physical, paper cash, it triggers a literal pain response in your brain. You feel the loss. But swiping or tapping a credit card? That completely decouples the pleasure of buying from the pain of losing money. In fact, there's this famous MIT study by Prelick and Semester that showed people are willing to pay up to 100% more for the exact same item when they're using a credit card instead of cash. Double. Combine that massive psychological blind spot with high compounding interest rates, the APR traps and hidden fees you get hit with if you don't pay off your full balance each month, and man, it becomes incredibly easy to fall into a spiraling debt cycle. So we've journeyed all the way from an era where an 1810 farmer borrowed seed based on a simple handshake with the local merchant, to the booming 1920s installment plans, to Frank McNamara's 1950 cardboard dinner tab, all the way to the instant global electronic approvals we use today. Credit has, without a doubt, built the modern consumer world. But as technology accelerates and our standard of living just keeps evolving, we really have to wonder, how will the next wave of financial innovation change the way we pay? Thank you so much for joining me on this explainer. Keep questioning the everyday things in your wallet, and I'll catch you next time.